Before we begin, it is critical to understand that this presentation is for informational and educational purposes only. I am not a financial advisor, attorney, or certified housing counselor. The information provided does not constitute financial or legal advice. Mortgage assistance programs and regulations change frequently, so you must consult with a qualified professional, such as a HUD-approved housing counselor, to analyze your specific financial situation and get personalized advice. Your home is your most valuable asset. Please treat this process with the professional guidance it deserves. The letter sits on your kitchen counter. You saw it in the mail pile and your stomach just dropped. It's from your mortgage company, and you know exactly what it's about. You're late. Maybe 1 month, maybe 2. You open it, and the formal cold language just confirms your worst fears. Notice of delinquency. Failure to cure the default. Foreclosure proceedings may be initiated. Suddenly it feels like the walls of your own home are closing in. The panic is real. The shame is overwhelming. Your mind starts racing. Where will we go? What did I do wrong? Is this the end of the line? Take a deep breath. Right now. Because what if I told you that letter is not an eviction notice? What if it's a starting gun? What if I told you there are powerful government-backed programs and little-known lender options designed specifically for people in your exact situation? Programs designed not to punish you, but to help you stay in your home. That's not just a hopeful statement, it's a fact. And over the next 10 parts of this series, I am going to give you the complete roadmap. We are going to pull back the curtain on the entire mortgage hardship industry. We will break down every single option step by step, from temporary payment pauses to permanent loan modifications that could lower your monthly payment for good. We're going to turn that feeling of panic into a powerful, actionable plan. You are not going to be a victim of the system. You are going to learn how to make the system work for you. First, let's get one thing straight. This is not your fault. Let me say that again. The financial hardship that led you here is not a reflection of your character or your worth. Life happens. For millions of Americans, the story is painfully similar. It's the sudden job loss in an industry that's downsizing. It's the unexpected, catastrophic medical bill that wipes out your savings in a matter of weeks. It's a divorce that suddenly cuts your household income in half, leaving you to cover a mortgage meant for 2 people. It's a sudden disability, a failed small business, or an adjustable rate mortgage that suddenly adjusted into the stratosphere, adding hundreds of dollars to your payment overnight. You are not lazy. You are not irresponsible. You are a person who has been hit by one of life's brutal curveballs. And the shame you feel? That overwhelming desire to hide the letters and avoid the phone calls? That's what the banks are counting on. They know that people who are ashamed and scared don't ask questions. They don't explore their options. They don't fight back. They just give up. They let the process happen to them instead of taking control. We are not going to do that. Starting today, that ends. So why do these assistance programs even exist? Is the government or your bank just being nice? Not exactly. It's about cold, hard economics. A foreclosure is a lose-lose-lose situation. First, you lose your home, which is the most significant source of wealth and stability for most American families. Second, the bank or investor who owns your loan loses a ton of money. Foreclosures are incredibly expensive for them, costing tens of thousands of dollars in legal fees, property maintenance, insurance, and lost value when they finally sell it at a discount. And third, your community loses. A street with foreclosed, vacant homes tanks property values for all your neighbors and destabilizes the entire neighborhood. It is in everyone's best interest, including your lenders, to find a solution that keeps you in your home, making payments. Even if those payments are smaller or paused for a while, it is almost always a better financial outcome for them than a foreclosure. Your goal, which is to stay in your home, and their goal, which is to avoid a costly foreclosure, are more aligned than you think. You just need to know the language to speak and the levers to pull to get to that mutually beneficial solution. These assistance programs are those levers. They are the structured pathways designed to prevent the worst-case scenario for everyone involved. Now, before we can talk strategy, we need to understand who we're actually dealing with. This is one of the most misunderstood parts of the mortgage world, and it is absolutely critical. There are 2 main players you need to know: the investor and the servicer. The investor is the entity that actually owns your loan. It might be a big bank like Chase or Bank of America, but very often, it's a government-sponsored enterprise like Fannie Mae or Freddie Mac. These 2 giants own or guarantee more than half of all mortgages in the United States. Your loan could also be an FHA loan, backed by the Federal Housing Administration, a VA loan backed by the Department of Veterans Affairs, or a USDA loan for rural housing. The point is, the investor is the ultimate owner. You'll probably never speak to them directly. The company you send your check to every month, the one that sent you that scary letter, the one you call with questions, that's your servicer. Their job is to be the middleman. They collect payments, manage the account, handle taxes and insurance through escrow, and deal with customer service. Here's the critical part. Your servicer doesn't make the rules. They have to follow a very specific set of rules and guidelines laid out by the investor who owns your loan. This is why one of the very first steps in this process is to find out who the investor on your loan is. Is it an FHA loan? A VA loan? Is it owned by Fannie Mae or Freddie Mac? Because the type of loan you have dictates the exact assistance programs, or loss mitigation options, that your servicer is legally required to offer you. They can't just say no. They have to evaluate you for specific options based on your loan type. Finding this out is your first piece of intelligence. You can often find this information on your mortgage statement, or by calling your servicer and asking directly, "Can you please tell me who the investor on my loan is?" This knowledge is power. It changes your conversation from, "Please, can you help me?" to "My loan is owned by Fannie Mae, and I would like to be evaluated for the loss mitigation options available to me under their guidelines." See the difference? One is a plea for help. The other is a statement of rights. Over the course of this series, we are going to arm you with that power. We will show you exactly how to find out who owns your loan. We will break down the specific programs available for each loan type. We'll talk about forbearance, which is a temporary pause or reduction of your payments to give you time to get back on your feet. We'll dive deep into loan modifications, which permanently change the terms of your loan to make your payments more affordable. This could mean lowering your interest rate, extending the term of your loan, or even forgiving a portion of the principal balance in some cases. We'll cover the new Homeowner Assistance Fund, a federal program providing billions of dollars to states to help homeowners with their mortgage payments, taxes, and insurance. We will give you scripts for what to say when you call your servicer. We will give you checklists for the documents you'll need to gather. The dreaded financial packet. We'll demystify the process so that when you submit that application, you are confident and prepared. Your first assignment right now isn't to make a phone call or fill out a form. It's to shift your mindset. Shift from the panic of that letter to the proactivity of a plan. Grab a notebook and a pen. Dedicate it to this process. Because the information in the next 9 parts is not just trivia. It is a practical step-by-step guide that could be the key to saving your home. You've taken the first step just by being here. Now let's get to work. The first thing we need to do is understand the battlefield. And make no mistake, while it's your home and your life, from the bank's perspective, this is a battlefield of numbers, risk, and regulation. To navigate it, you need to know who the players are. This is the single biggest point of confusion for homeowners, and getting it wrong can cost you precious time. You might think you have a mortgage with, say, Big National Bank. You send your check to them, you see their logo on the statements, but it's almost never that simple. In reality, there are usually 3 key entities involved in your loan: the investor, the lender, and the servicer. Think of it like this: imagine a restaurant. The person who actually put up the money to build the restaurant, buy the equipment, and who ultimately owns the whole operation, that's the investor. You, the customer, never meet them. They're behind the scenes. In the mortgage world, this could be a government-sponsored entity like Fannie Mae or Freddie Mac, or a group of private investors on Wall Street. They own your loan. They own the debt. They set the ultimate rules for what can and cannot be done if you get into trouble. Next, you have the restaurant manager. This person was hired to run the place, maybe they helped set it up. This is the lender. This is the company whose name you probably remember from your closing documents, the Big National Bank you thought you were dealing with. They originated the loan. They processed your application, verified your income, and gave you the money. But very often, right after they do that, they sell the loan to the investor. Their primary role is often finished once the loan is made. Finally, and this is the most important person for you right now, you have the waiter. The waiter is the person you interact with. They take your order, bring you your food, and collect your payment. They didn't cook the food, and they don't own the restaurant, but they are your sole point of contact. This is your mortgage servicer. The servicer is the company that sends you your monthly statements, collects your payments, manages your escrow account for taxes and insurance, and critically, is the department you must deal with when you're in financial hardship. Sometimes the lender and the servicer are the same company, but very often they are not. Your original lender might sell the servicing rights to a completely different company that specializes in collecting payments. You can find out who your servicer is by looking at your most recent mortgage statement. The company you send your check to? That's your servicer. They are your first and for a while your only phone call. Calling the original lender is often a waste of time. Calling the investor is impossible. You must deal with the servicer. They are the gatekeepers. Now, why is this so important? Because the servicer is operating under a specific set of rules laid down by the investor. When you ask for help, the servicer doesn't just get to decide on a whim what to offer you. They have to follow the investor's guidelines. A loan owned by Fannie Mae will have different assistance options than a loan owned by a private investment trust. Part of this process, which we'll cover later, is figuring out who the investor on your loan is, because it dictates your entire playbook. But for now, all you need to know is your target, the servicer. Your goal is to make contact with their loss mitigation department. That's the official name for the department that handles troubled loans. Loss mitigation simply means trying to minimize the loss for the investor. Notice the name. It's not the Homeowner Assistance Department. It's the Loss Mitigation Department. This is a crucial mindset shift. You are not calling to beg for mercy. You are calling to open a business negotiation about how to best mitigate the investor's potential loss. This reframes the entire conversation. It takes you from a position of weakness to a position of a proactive business partner. So, when do you make this call? The answer is, as soon as you know you're going to have trouble. Ideally, before you miss your first payment. I know this is counterintuitive. Your instinct is to hide, to hope a miracle happens before the due date. But in this world, early communication is a sign of a responsible borrower. It shows you're not just walking away. It gets you on their radar in a positive way and opens up options that may disappear the moment you become delinquent. Reaching out before you're 30 days late can be a massive advantage. Before you pick up the phone, take a deep breath and gather 3 things. First, your loan number. It's on your statement. Second, a simple, clear, and concise explanation of your hardship. You don't need to tell them your entire life story. It needs to be a straightforward statement. I've had a medical emergency. My spouse was laid off. My self-employment income has been drastically reduced due to market conditions. Keep it short and factual. Third, have your basic financial information handy. They're going to want to know your approximate current monthly income. You don't need a full spreadsheet yet, just a general idea. Now for the call itself. When you get a representative from the Loss Mitigation Department on the line, here is your opening. Hello, my name is your name, and my loan number is your loan number. I'm calling today because I'm experiencing a financial hardship, and I will be unable to make my next payment. I want to be proactive and I'd like to learn about the mortgage assistance options available to me. That's it. That is the perfect opening. It's calm, it's professional, and it uses their language. You've stated the problem, shown you're responsible, and asked for the specific information you need. There's a critical mistake many people make on this call. They get emotional. They get angry. They start blaming the bank or the economy. I understand the temptation. You're scared, you're stressed, and you feel like a victim. But the person on the other end of that phone is a call center employee following a script. Yelling at them is like yelling at the waiter because you don't like the prices on the menu. It accomplishes nothing and makes them less likely to want to help you. Remember, this is a business negotiation. Stick to the facts. Be polite, be firm, and be persistent. During the call, your goal is to accomplish one thing: to have them send you a loss mitigation application package. This is sometimes called a hardship application or a request for mortgage assistance. It's a packet of forms that you will need to fill out to formally apply for help. Ask them to send it to you, confirm the address, and ask if you can also download it from their website to get started sooner. Take notes during the call. Get the representative's name and an ID number if they offer one. Write down the date and time of the call. This is the beginning of your paper trail, and a paper trail is your best friend. After the call, they will mail you this packet. And when it arrives, it's going to be intimidating. It can be dozens of pages long, asking for detailed financial information, bank statements, pay stubs, tax returns, and a formal hardship letter. It will feel overwhelming. It's designed to be. It's a filter. Many people get this packet, feel defeated, and never send it back. You will not be one of those people. You've now successfully completed the first active step. You've identified the right entity to contact, your servicer. You've prepared for the call, and you've initiated a formal request for assistance. You have officially moved from a state of passive worry into a state of active problem solving. You've put the ball in motion. That packet of paperwork is your ticket to the next stage. And it's your opportunity to formally make your case. But it's also a minefield of potential errors that can get your application instantly denied. So let's defuse that minefield one step at a time. The single biggest reason applications are denied on the first pass isn't because the hardship isn't real. It's not because a solution doesn't exist. It's because of simple, avoidable paperwork errors, incomplete forms, missing signatures, numbers that don't add up. Think of it from the servicer's perspective. They have a team of people, underwriters, reviewing hundreds, maybe thousands of these packets. Their job is to follow a checklist. If your packet doesn't tick every single box, it gets pushed to a rejection pile, and they move on to the next one. They don't have time to call you and ask why page 4 is missing, or why the income on your financial worksheet doesn't match your pay stubs. It's a brutal and personal process. Your job is to make it impossible for them to say no. You need to hand them a perfect, undeniable, self-contained case for assistance. This case is built on 3 pillars. First, your story, the hardship letter. Second, your numbers, the financial worksheet. And third, your proof, the supporting documentation. Get these 3 things right and you've just leapfrogged over 90% of the other applicants who rush through it. Let's start with the most personal part. The hardship letter. This is not the time for a 5-page emotional epic. It needs to be a clear, concise, and factual account of what happened. They don't need to know about the argument you had with your cousin last Thanksgiving. They need a timeline. The core of a powerful hardship letter answers 4 questions. 1. What was your financial situation before the hardship? 2. What specific event happened that caused the hardship? 3. How has that event directly impacted your ability to pay your mortgage? And 4. What is your plan or expectation for the future? Let's break that down. Before the hardship establishes your history as a responsible borrower. A simple sentence like, "For the past 7 years we have made our mortgage payments on time without issue," sets the stage. It shows this is a new problem, not a chronic one. Next, the event. Be specific. Don't just say, "I lost my job." Say, "On May 12th, my employer, ACME Manufacturing, initiated a company-wide layoff, and my position as a shift supervisor was eliminated." Don't just say, "I had a medical issue." Say, "I underwent emergency surgery on June 3rd, resulting in a 6-week unpaid medical leave from work." Give them a date. Give them a concrete event. This turns a vague problem into a verifiable fact. Then connect the dots. This is the most crucial part. How did that event cause this problem? The elimination of my position cut our household income by 60%, making it impossible to cover both our mortgage and essential living expenses. Or, the unpaid medical leave exhausted our emergency savings, which we previously used to cover any short-term shortfalls. You are drawing a straight, undeniable line from the cause to the effect. Finally, the future. This shows them you're thinking about a solution, not just a handout. It can be something like, "I am actively seeking new employment and have had 3 interviews in the past 2 weeks." Or, "My doctor has cleared me to return to work on a part-time basis starting August 1st, and I expect to return to full-time by September." It shows there's light at the end of the tunnel. It tells the servicer that any assistance they provide is a bridge to get you back on your feet, not a permanent solution for a hopeless situation. Keep it to 1 page. Be honest, be factual, and be professional. Sign and date it. This letter is the beating heart of your application. Now for the second pillar. The numbers. This is your financial worksheet, often called a request for mortgage assistance or RMA form. If the letter is the heart, this is the cold, logical brain. This document is a snapshot of your entire financial life. Every dollar coming in, every dollar going out. And I mean every dollar. This is where most people trip up. They'll list their car payment and their electric bill, but they'll forget about the Netflix subscription, the kids' weekly pizza night, the monthly pest control service. You have to be meticulous. Go through your last 3 months of bank and credit card statements with a fine-tooth comb. Categorize everything. The servicer is going to do something called calculating your debt-to-income ratio based on this sheet. They're comparing your total monthly debt payments to your total monthly income. But they're also doing something more basic. They're looking for red flags. If your hardship letter says you lost your job, but your financial worksheet shows you're spending $400 a month on restaurants and entertainment, that's a red flag. Tells a conflicting story. If you claim your grocery bill is only $200 a month for a family of 4, That's a red flag because it's not realistic. They know what average costs are. Be honest and be thorough. This worksheet needs to paint a picture of a household that has cut back to the bare essentials and is still coming up short. The final number, your monthly shortfall, should be the undeniable mathematical proof of the story you told in your hardship letter. Which brings us to the third pillar, the proof. Everything you've written in the letter and the worksheet must now be backed up with hard evidence. This is where you assemble your arsenal of documents. They will send you a specific list, and your job is to provide exactly what they ask for. Not more, not less. If they ask for 2 recent pay stubs, send 2. Not 1, not 3. If they ask for the last 60 days of bank statements, send every single page. Yes, even the blank one at the end that says, "This page intentionally left blank." You'd be amazed at how many applications get kicked back because a reviewer sees page 7 of 8, and page 8 isn't there. You'll typically need proof of income. This could be pay stubs if you're employed. If you're self-employed, this is harder. You'll need profit and loss statements, maybe for the last year. Be prepared to show how your income has dropped. If you're receiving unemployment, you'll need the benefits letter. Same for disability or Social Security. If you have no income at all, you may need to sign a form attesting to that. You'll need bank statements. They're looking at your deposits to verify your income, and they're looking at your spending habits to verify your expenses. They're also looking for large, unusual deposits. If your uncle gave you $5,000 to help out, you need to be prepared to explain that with a gift letter. Otherwise, they might count it as undisclosed income. You might need your most recent tax returns signed and dated. This is another cross-reference point for them to verify your long-term income history. Don't fudge the numbers. The information on your tax return, your pay stubs, and your financial worksheet must all align. An underwriter's entire job is to spot discrepancies. If your worksheet says you make $3,000 a month, but your pay stubs and bank deposits show you're making $4,000, your application is done. Your credibility is shot. This whole process is about building a fortress of consistency. Your letter tells a story. Your worksheet quantifies that story with numbers. And your documents provide the ironclad proof for every single claim and every single number. When an underwriter picks up your packet, they shouldn't have a single question. It should be so clear, so well documented, and so consistent that approving you for the next step is the easiest, most logical thing for them to do. Take your time. Make a checklist. Double-check everything, then have a spouse or a trusted friend check it again. This packet of paper represents your best, and sometimes your only shot at saving your home. Don't let a simple mistake be the thing that stands in your way. Once it's perfect, you make a complete copy of the entire package for your own records, and you send the original via a trackable method like certified mail. That receipt is your proof that they received it. And then the waiting begins. You've sent your story, your numbers, and your proof out into the void. This is when the anxiety really kicks in. What's happening on the other end? Did they even get it? Is someone looking at it? But what you do during this waiting period is just as critical as the work you did to prepare the packet itself. There are moves you need to make, and one catastrophic mistake you absolutely must avoid. That one catastrophic mistake you absolutely must avoid is this: going silent. It's the single most destructive thing you can do during this agonizing waiting period. You've sent in a mountain of paperwork, you've poured your financial soul onto those pages, and now crickets. So you wait. You figure, no news is good news. You might even think, I shouldn't bother them, they're busy. Worse, you might make the fatal assumption that because you've applied for help, you can just stop making your mortgage payments. Do not do this. I cannot say it loudly enough. Stopping payments without a written formal agreement in place, like a trial modification plan, is like telling your lender, go ahead, start the foreclosure process. Because in their system, that's exactly what happens. An unmade payment triggers alarms. It starts a clock you cannot turn back. Submitting an application for assistance does not, in most cases, automatically pause your obligation to pay. It doesn't put a magic shield around your home. You are still contractually obligated to make your payment until you have a piece of paper in your hand that explicitly tells you otherwise. Going silent and stopping payments is the fastest way to get your application denied and your home put on the foreclosure track. The lender sees you as non-cooperative. They see you as a higher risk. You've broken the fundamental agreement, and it shatters any goodwill you've built. So what's the alternative to this disastrous silence? It's what we'll call strategic, documented communication. Your new part-time job is becoming the world's best project manager for your own mortgage. Your very first move, about 3 to 5 business days after you've sent your packet, is to pick up the phone. You are not calling to ask for a decision. You are calling with one simple goal: to confirm they have received your complete application package. Don't just ask, "Did you get my stuff?" Be specific. "Hello. I'm calling to confirm receipt of the loss mitigation package I sent on date. My loan number is," your loan number. When you get that confirmation, your next question is the most important one you will ask in this entire process. "Can you please tell me the name and contact information for my assigned single point of contact?" A single point of contact, or SPOC, is a specific person or a dedicated team at the mortgage servicing company assigned to help you. Federal regulations, specifically the Dodd-Frank Act reforms, made this a requirement for many servicers to help homeowners avoid the nightmare of being passed around from department to department, having to retell their story a dozen times. Your SPOC is your lifeline. They are your navigator. Get their name, their direct extension if they have one, and their email address. From this moment on, you communicate primarily with them. This prevents confusion, creates accountability. Now we begin phase 2 of your new project management job: building your case file. Get a notebook, a binder, or start a document on your computer. Every single time you interact with your lender, you log it. Every call, every email, every piece of mail. For phone calls, you write down the date, the time, the full name of the person you spoke to, and a summary of what was discussed. Spoke to Jane Smith at 3:15 p.m. on Tuesday. Confirmed she received the updated pay stub I faxed. She said my file is now with the underwriters and to expect a 30-day review period. This isn't paranoia. This is protection. This log is your evidence. If someone later claims they never received a document, you can say, "Actually, I have a note here that I spoke to Jane on this date and she confirmed receipt." It shows you are organized, serious, and on top of your situation. You're not a passive victim of circumstance. You are an active participant in the solution. This documentation can be absolutely invaluable if you later need to dispute a decision or escalate your case to a consumer protection agency. Now let's talk about the elephant in the room: the monthly payment. We've established that just stopping is a disaster. But what if you truly cannot afford to make the full payment while you wait? You still have to communicate. You call your SPOC and you explain the situation. "I'm waiting on a decision for my application, but I do not have the full mortgage payment this month. I can pay a specific amount. Can the bank accept a partial payment while my application is under review?" Be prepared for their answer. Some lenders will accept it, others will not. Some have policies where a partial payment is automatically rejected and sent back. Others might accept it but warn you that it will not stop late fees or prevent them from beginning the foreclosure process. The key is that you are asking. You are being transparent. You are not hiding. If they say no, you document it in your log and you continue to follow up on your application. The goal is to get to a formal written plan that changes your payment amount. Until you have that, the original terms of your loan are still in effect. To understand why this process feels so slow and why they're so rigid, you have to pull back the curtain on how the lender's side works. It's not just one person at a desk looking at your story and making a gut decision. Your application is fed into a complex system. An underwriter is assigned, and their job is to run your financial data through what's called a waterfall. Imagine a series of tests, one after the other. First, they check if you qualify for the top-tier government programs like a FHA HAMP modification if you have an FHA loan. If you don't pass the test for that one, your file cascades down to the next option, maybe a different government program. If you fail that, it cascades down to the lender's own private or proprietary modification programs. Each one has different rules about your debt-to-income ratio, your type of hardship, and the loan status. The underwriter is trying to solve a complex math problem. The ultimate goal for the investor who actually owns your loan, which might be a pension fund or an investment group, not necessarily the bank you talk to, is to determine the net present value, or NPV. This is a cold, hard calculation. They're asking, which scenario makes more money for the investor in the long run? Modifying your loan so you can keep paying, or foreclosing on the property and selling it? Your hardship letter and your story provide context, but the final decision often comes down to this NPV calculation. It's not personal, it's business. Understanding this helps you stay objective and focused on providing the numbers they need to make the calculation work in your favor. And then it happens. An email or a call from your SPOC. "Hi, we're reviewing your file, but the underwriter needs an updated bank statement." The one you sent is now more than 30 days old. Your first instinct is to scream. You want to say, "I sent you that. If you had looked at it sooner, it wouldn't be out of date." Take a deep breath. Do not get angry. Do not argue. A request for more documents, as frustrating as it is actually a good sign. It means someone is actively working on your file. It means it hasn't been thrown in a denial pile. Your job is to make their job as easy as possible. You are not trying to win an argument. You are trying to save your home. So you say, "Absolutely. I can get that to you right away." What is the best way to send it to ensure it gets to the right person immediately? You get the updated document and you send it that same day. Then you follow up with an email or a call to your SPOC to, you guessed it, confirm they received it. And you log it all in your notebook. Every request for more information is a test of your responsiveness. Delays on your end can cause your application to be closed for being incomplete. Be faster than they expect. This period of waiting is a test of your nerve. It's a marathon of follow-ups and paperwork. But by being proactive, by documenting everything, and by understanding the process, you are taking back control in a situation that feels completely out of control. You are building a case for yourself, not just with your documents but with your conduct. And eventually the waiting does end. The phone will ring, or a thick envelope will arrive in the mail. Your hands might be shaking as you open it. It's the decision. It's either the relief you've been praying for, or the news you've been dreading. Next, we're breaking down exactly what to do in both scenarios, approval and denial. Because even an approval comes with its own set of critical next steps and potential traps you need to navigate perfectly. So let's start with the best-case scenario. After weeks, maybe months of agonizing uncertainty, a thick envelope arrives. You open it and the words leap off the page. "Congratulations, you have been approved for a trial period plan." The relief is immense. Feels like you can finally breathe. But I need you to listen to me very carefully right now. This is the single most dangerous moment in the entire process. Why? Because the relief makes you lower your guard. And the fight is not over. It has just entered a new, more technical phase. That approval is almost always for a trial period plan, or TPP. Think of this as a probationary period. The lender is testing you. They are offering you a new temporarily reduced payment for 3, sometimes 4 months. Your only job during this period is to make every single one of those payments on time, in full, exactly as instructed. Not a day late. Not a dollar short. If the payment is due on the 1st, don't pay it on the 2nd. If they tell you to pay online, don't mail a check. You must be flawless. One slip-up, one late payment, and in most cases the entire modification offer is permanently revoked, and you are right back at square one, but with even less credibility in the eyes of the lender. During this trial period, you are proving 2 things: that you have the financial stability to handle the new payment, and that you are a reliable borrower. While you are making these payments, the lender is supposed to be preparing the final, permanent loan modification agreement. Once you successfully complete the trial period, they will send you the final package. This is your second most dangerous moment. You will be tempted to just sign it and send it back to finally put this nightmare behind you. Do not do that. You must read every single word of that final agreement. This document will govern the next 15, 30, maybe even 40 years of your financial life. What are you looking for? First, check the new interest rate. Is it fixed for the life of the loan? Or is it a low introductory rate that will balloon in 5 or 7 years? An adjustable rate mortgage or ARM might look great now, but it could put you right back into hardship down the road. You need to know exactly what you're agreeing to. Second, look at the new principal balance. All those payments you missed, plus late fees and other costs, have likely been added back into your loan balance. This is called capitalization. Your loan amount has actually gone up. You need to see that number in black and white and understand how they calculated it. Third, what is the new term of the loan? They often extend the loan term back out to 30 or even 40 years to get the payment down. This means you'll be paying for much longer, and will pay significantly more in total interest over the life of the loan. It's a trade-off for immediate affordability, but you need to be aware of the long-term cost. And finally, search for the deadliest trap of all: a balloon payment. Some modifications are structured to have low monthly payments for a period of time, say 10 or 15 years, but then require the entire remaining balance to be paid in one massive lump sum. Imagine paying your mortgage diligently for a decade, only to suddenly owe $100,000 you don't have. It's a foreclosure time bomb, and you have to make sure it's not hidden in your agreement. If you see anything you don't understand, You must ask for clarification in writing before you sign. Once you sign and return that final agreement, and it's executed by the lender, keep a copy in a safe place forever. Keep a copy of your trial plan offer. Keep proof of every trial payment you made. This paperwork is your armor. Years from now, if a new company buys your loan and claims you owe more, this is your proof. It's your defense. Okay, that's the happy path, fraught as it is with its own challenges. But what if the envelope contains the news you've been dreading? A denial. The words feel like a punch to the gut. We are unable to offer you assistance at this time. Your first instinct might be despair. The feeling that you've hit a brick wall and foreclosure is now inevitable. That is exactly what your lender is counting on. But this is not the end. This is where you start to fight smart. Your first action is not to panic. It's to understand. By law, the denial letter must state the specific reason or reasons for the denial. Vague answers are not acceptable. You need to find that reason. The most common one is something called the net present value or NPV test. In simple terms, this is a complex calculation the lender uses to determine if they will make more money modifying your loan or simply foreclosing on it. If the calculation shows foreclosure is more profitable for their investors, they will deny you. It's cold, it's brutal, it's just math to them. Other common reasons for denial include: your application was incomplete, you missed a document or a signature, your income is too low to support even a modified payment, or surprisingly, your income is considered too high, meaning they believe you can afford your original payment even if you know you can't. Whatever the reason, your next step is critical and time-sensitive. You have the right to appeal. The denial letter must provide information on how to file an appeal, and you typically only have 14 to 30 days to do it. This is your formal opportunity to tell them they made a mistake. But you can't just say, "You're wrong, please look again." That will be denied instantly. An effective appeal requires you to address the specific reason for denial with new information. If they said your income was too low, maybe you just got a raise or your spouse started a new job, provide the new pay stubs. If they said your application was incomplete, provide the missing document immediately. If you were denied based on that NPV calculation, this is tougher, but you can appeal by arguing they used incorrect inputs. Did they have the wrong information about your property taxes? Did they incorrectly estimate your home's current value? You can provide a broker's price opinion or other evidence to challenge their numbers. The goal of the appeal is to give them a concrete, documented reason to reverse their decision. But what if the appeal is also denied? Do you give up then? Absolutely not. Now you escalate. Every major lender has an internal escalation department. It might be called the Office of the President, the Executive Resolution Team, or an ombudsman. Your job is to bypass the frontline customer service and get your case file in front of this higher-level team. These are the internal problem solvers who have the authority to override the decisions made by the lower-level processors. You write a clear, concise, professional letter explaining your situation, the reason for the denial, and why you believe it was made in error. You include all your documentation, and if even that doesn't work, you go outside the bank. You take your fight to the regulators. Your most powerful tool here is the Consumer Financial Protection Bureau, the CFPB. This is a federal government agency designed to protect consumers in the financial marketplace. You can file a complaint against your lender online for free. It's a straightforward process. You detail your entire saga, the application, the denial, the appeal. Once you submit that complaint, the CFPB formally forwards it to your lender, and the lender is legally required to investigate and provide a formal, written response back to you and the CFPB. This forces a senior-level compliance officer at the bank to review your entire case file from the beginning. It gets your case out of the normal, often broken processing system and puts it under a federal microscope. You'd be amazed at how often unsolvable problems suddenly find a solution when the CFPB gets involved. You can also file complaints with your state's Attorney General or Department of Banking. The key takeaway is this: a denial is not a final judgment. It is an opening bid in a negotiation you may not have even known you were in. It's a test of your resolve. Whether you're navigating the complexities of a trial plan or fighting a denial, the path forward is paved with documentation, persistence, and a refusal to simply accept the first no you receive. You have rights, you have options, and you have more power than you think. And that power is magnified tenfold when you realize you don't have to fight this battle alone. For every homeowner feeling isolated, drowning in paperwork, and getting the runaround from their servicer, There is a network of expert advocates whose entire mission is to stand in your corner. This isn't some secret society. It's a nationwide, government-supported infrastructure designed for this exact crisis. And accessing it is the single most powerful step you can take right now. We're talking about HUD-approved housing counselors. Now, I know what some of you might be thinking. A counselor? What are they going to do? Talk about my feelings? Let me be crystal clear. These are not therapists. These are highly trained, certified financial specialists. They are navigators, translators, and strategists. They speak the arcane language of mortgage servicing fluently. They know the specific programs, the legal requirements, the loopholes, and the pressure points of the very system that feels so impenetrable to you right now. And here's the most important part. They work for you, for free or at a very low cost. They are funded by government grants and nonprofit organizations. Their success is not measured by how much money they make off you, but by how many families they can keep in their homes. This is a critical distinction, because the mortgage distress landscape is littered with predators. You've probably seen the ads online or gotten the mailers. Foreclosure rescue. We can save your home. Guaranteed. These are for-profit companies that charge exorbitant fees for things you can do for free. Or worse, they are outright scams designed to steal your money or even the title to your home. A HUD-approved housing counseling agency is the polar opposite. It is your shield against those scams and your sharpest weapon in negotiations with your lender. Let me tell you about a woman we'll call Maria. Maria was a registered nurse, a single mom with 2 kids, living in a modest 3-bedroom home in a suburb outside of Phoenix. For 12 years, she never missed a mortgage payment. It was her anchor, the one stable thing in her kids' lives. Then, a severe back injury from lifting a patient put her on long-term disability. Her income was slashed by more than half overnight. For the first 3 months, she drained her savings to make the payments. The 4th month, she paid half. The 5th month, she couldn't pay at all. The calls started. First, polite reminders. Then more insistent demands. Soon, she was getting letters filled with terrifying words like default, acceleration, and foreclosure. She tried calling her servicer, the big national bank whose name you'd recognize. She'd spend hours on hold, only to be transferred from one department to another, asked for the same document she'd already sent 3 times, and given conflicting information by every person she spoke to. She was panicked, exhausted, and utterly hopeless. She started packing boxes in her head, trying to figure out which of her kids' treasured belongings they could take to a small apartment. One night, while desperately searching online, she saw a link on her state's official government website to something called the HUD Office of Housing Counseling. Skeptical but out of options, she found a local agency on the list and made the call the next morning, fully expecting another dead end. What she got was a calm, professional voice on the other end of the line. The woman's name was Anna. She didn't judge. She didn't make false promises. She just listened. For the first time in months, Maria told her entire story to someone who actually understood what she was talking about. Anna then said the 7 words that changed everything for Maria. "Okay, let's make a plan together." That plan was a revelation. Anna first had Maria sign a third-party authorization form, a simple document that gave the counseling agency permission to speak to her mortgage servicer on her behalf. Suddenly, Maria wasn't alone on those calls anymore. The next time they called the bank, Anna was on the line with her. The tone from the servicer's representative changed instantly. They were no longer talking to a flustered, emotional homeowner. They were talking to a certified professional who knew their own rules and regulations better than they did. Anna worked with Maria to create a bulletproof loss mitigation package. She didn't just say, "Send your pay stubs." She said, "Your disability income is documented this way. We need this specific letter from your doctor, and we need to present your budget in this exact format to maximize your chances of approval for a modification." They went through Maria's finances with a fine-tooth comb, creating a realistic household budget that showed exactly what she could afford to pay. Anna helped her write a powerful, concise hardship letter that clearly explained her situation without the desperate, rambling emotion that often gets homeowner applications ignored. The counselor knew about a specific FHA-insured loan modification program that Maria was eligible for, one that none of the 10 different bank representatives had ever mentioned. Anna knew the specific name of the program, the exact eligibility criteria, and the documents required. She essentially handed the servicer an undeniable, perfectly packaged application for a solution they were legally obligated to consider. 2 months later, Maria received a trial plan offer. It wasn't a vague promise. It was a concrete offer for a loan modification that would lower her monthly payment by nearly $400, putting it just within reach of her new disability income. After successfully making 3 trial payments, the modification became permanent. The boxes in her head disappeared. The anchor was secure again. Maria didn't just save her house. She regained her dignity and her sense of control, all because she made one phone call to a free nonprofit expert. Maria's story is not unique. There are thousands of these counselors and agencies all across the country. Finding them is simple, but you have to be careful. Do not just Google foreclosure help. Go directly to the source. Go to the U.S. Department of Housing and Urban Development website, HUD.gov, or simply search for the phrase "Find a HUD-approved housing counselor." The official government site has a search tool where you can find a list of legitimate, certified agencies in your area. When you go to your first appointment, be prepared. Bring everything you can. Your most recent mortgage statement, proof of income for everyone in the household, your last 2 tax returns, a list of your monthly household expenses, and any letters you've received from your servicer. The more information you can provide, the faster they can help you build your plan. Remember, their job is to serve as your personal project manager for saving your home. They will help you understand your options, whether it's a repayment plan, forbearance, a loan modification, or even, in some cases, a graceful exit from the home through a short sale or deed in lieu that avoids the credit-destroying devastation of foreclosure. And their expertise often extends beyond just dealing with your primary mortgage. They are deeply connected to the support systems in your community. They know about state-run programs, like the Homeowner Assistance Fund, or HAF, a federal program administered by the states that provides grants to help homeowners catch up on mortgage payments, property taxes, and utilities. They can connect you with legal aid societies if your case requires legal intervention, or with local charities that can help with food or utility bills, freeing up cash to put toward your housing payment. They are the hub of a wheel of resources you probably don't even know exists. Engaging with a HUD-approved housing counselor is not a sign of failure. It is a strategic move. It's like a chess player bringing a grandmaster in to look over their shoulder. You are still the one making the moves, but now you have an unparalleled expert guiding your hand, anticipating your opponent's strategy, and showing you the path to checkmate. You've been fighting a complex bureaucratic war on your own. It's time to bring in the special forces. Now that you know how to find your advocate, your guide through this process, we need to arm you with their knowledge. We need to open up the playbook of solutions they use every single day. Because once you understand the specific government-backed programs and powerful modification options available, you're no longer just asking for help. You're demanding a solution you know you're entitled to. So what does that playbook look like? It starts by identifying exactly who backs your loan, because the rulebook changes depending on the player. Is it an FHA loan, a VA loan, or a conventional loan owned by Fannie Mae or Freddie Mac? Knowing this one piece of information is like knowing the secret password. Changes everything. Let's start with one of the most common, especially for first-time homebuyers, the FHA-insured loan. If you have an FHA loan, you need to understand a critical concept called the loss mitigation waterfall. Imagine a series of cascading steps. Your servicer is required by law to evaluate you for each option in a specific order. They can't just jump to the end and say, "Sorry, we can't help." They have to follow the waterfall. The first step is typically a forbearance plan. This is a temporary pause or reduction in your payments, usually for a few months, to give you time to resolve a short-term hardship. But the real power in the FHA playbook comes after that. The next step is a loan modification. The flagship program here is the FHA HAMP, or Home Affordable Modification Program. This is a permanent restructuring of your loan to create a more affordable payment. But here is the FHA's ace in the hole, the tool that sets it apart from almost every other loan type. The FHA partial claim. This is, without a doubt, one of the most powerful hardship solutions in the entire mortgage industry. Let me explain how it works because it's a game changer. Let's say due to a job loss, you fell 6 months behind on your mortgage, and your total past due amount is $10,000. You're back on your feet now, but you don't have a lump sum of $10,000 to catch up. Under the partial claim, the FHA steps in. They essentially advance that $10,000 to your mortgage servicer, bringing your loan completely current overnight. Now, what happens to that $10,000? It's placed into a second subordinate lien against your property. But here's the magic. This second lien has 0% interest, and it requires 0 monthly payments. It just sits there silently in the background, You don't have to pay it back until you either sell the house, refinance your mortgage, or pay off your original loan completely, whichever comes first. This tool allows you to instantly cure a major delinquency and get back on track with your regular payments without having to come up with a massive lump sum or a punishing repayment plan. When you call your servicer and you say, "I have an FHA loan and I believe I qualify for a partial claim," you are signaling that you know the rules of the game. You're not just asking for help. You're referencing a specific, powerful solution they are obligated to consider. Now let's talk about another critical group, our nation's veterans. If you have a VA loan, you have a unique and powerful ally in your corner: the Department of Veterans Affairs itself. The VA's mission is not just to help veterans buy homes, but to help them keep them. Servicers of VA loans have a higher duty and less flexibility to be difficult. The VA actively encourages servicers to work with homeowners and provides them with tools to do so. If you fall behind, the VA can get directly involved. They can provide financial counseling and even mediate with your mortgage servicer on your behalf. There have been countless instances where a veteran was struggling to get a straight answer from their bank, and a single call from a VA loan specialist completely changed the dynamic. The VA also has its own array of options, from repayment plans to special forbearance and loan modifications. In some very specific, last resort situations, the VA might even be able to offer what's called refunding, where the VA essentially buys the loan from the servicer and takes over the servicing itself, giving the veteran a fresh start. The key takeaway for anyone with a VA loan is this: you are never alone in this fight. The institution that guaranteed your loan in the first place is there to back you up when you face hardship. The same spirit applies to USDA loans, which are designed to help families in rural areas. The USDA has its own robust set of special loan servicing options. They understand that financial hardships in rural communities can be unique, and their programs reflect that. They offer term extensions, interest rate reductions, and modification plans specifically designed to keep people in their homes. Like the VA, they take a very hands-on approach to loss mitigation. But what about the majority of mortgages in America? The conventional loans? This is where two names you've probably heard but might not fully understand become incredibly important: Fannie Mae and Freddie Mac. These are not direct lenders. They are massive government-sponsored enterprises, or GSEs, that buy mortgages from lenders, package them as securities, and sell them to investors. If your conventional loan is owned by Fannie or Freddie, which is highly likely, then your servicer must follow their rules for hardship assistance. And their flagship program is the Flex Modification. The Flex Mod is a standardized process designed with a very clear target: to reduce your monthly principal and interest payment by approximately 20%. To get there, the servicer pulls a series of levers in a specific order, very similar to the FHA waterfall. First, they take the total amount you're behind, the past due payments, the late fees, any legal costs, and they add it to your principal loan balance. This is called capitalization. It brings you current, but it also makes your loan balance bigger. Second, to counteract that bigger balance, they extend the term of your loan. For a flex modification, they can re-amortize your new, higher balance over up to 480 months. That's a 40-year term. By stretching the payments out over a longer period, they dramatically lower the monthly amount. Third, if extending the term isn't enough to hit that 20% reduction target, they will look at lowering your interest rate to the current market rate. But what if they do all three of those things: capitalize the arrears, extend the term to 40 years, and lower the rate, and the payment is still not affordable enough? This is where another incredibly powerful tool comes into play: principal forbearance. Just like the FHA partial claim, this is a way of setting a portion of your debt aside. With a flex modification, they can take up to 30% of your new principal balance and set it aside as a non-interest-bearing amount. You don't make payments on it. It's just deferred, due at the end of the loan. This directly reduces the portion of your balance that is actually calculating interest and payments, resulting in a significant drop in your monthly obligation. Understanding these specific programs, the FHA partial claim, the VA's direct intervention, the USDA's special servicing, and the Fannie/Freddie flex modification, is absolutely critical. These are not vague promises of help. They are structured, defined, and regulated processes. They are the exact tools the servicers use. Knowing the name of the tool, how it works, and why you qualify for it transforms your conversation with your lender. You are no longer a passive victim of your circumstances. You are an informed homeowner, advocating for a specific, established solution designed for your exact situation. And the first step in advocating for yourself is to build your case. Think of it like a lawyer preparing for trial. You wouldn't just walk into a courtroom and say, "I'm in trouble, please help." You'd walk in with a file full of evidence, organized, documented, and ready to present. That file is your power. It's what separates a desperate plea from a formal request. So, where do we begin building this file? We start with the heart of your story, the hardship letter. This is, without a doubt, one of the most critical and most misunderstood pieces of the puzzle. Many people either rush through it or pour so much raw emotion into it that the key facts get lost. A lender isn't your therapist. They are a financial institution looking for a clear, logical reason why they should modify the terms of a legally binding contract. Your letter needs to provide that reason. A successful hardship letter has three core components. It must be clear, it must be concise, and it must be compelling. First, clarity. State the nature of your hardship directly in the first paragraph. Don't bury the lead. I am writing to request mortgage assistance due to a significant reduction in my income following a layoff from my job on March 15th. Or, my family has experienced a financial hardship as a result of unexpected medical bills totaling over $30,000. Be specific. Vague statements like, "I'm having a tough time," are immediately dismissed. State the what and the when right at the top. Second, conciseness. Your servicer's loss mitigation department reviews hundreds, if not thousands, of these cases. A 10-page single-space saga of every misfortune you've ever had will not be read thoroughly. It will be skimmed. Your goal is to tell a powerful story in about one page. Stick to the relevant facts. Explain the timeline of events. What was your financial situation before the hardship? What specific event occurred? How did that event directly impact your ability to pay your mortgage? And crucially, what has changed or what do you expect to change that will allow you to resume payments even if modified? Third, and most importantly, it must be compelling. This doesn't mean it has to be a tearjerker. It means it has to connect the dots for the lender in a way that makes sense. It has to be believable and backed by evidence. If you lost your job, you'll later provide a termination letter. If you had a medical issue, you'll provide hospital bills. The letter is the narrative that ties all your documentation together. It should also convey a sense of responsibility. End the letter by stating your commitment to your home and your desire to find a workable solution. Something like, "My home is vital to my family's stability, and I am fully committed to meeting my obligations. I am confident that with a temporary modification, I can get back on track and continue to be a responsible homeowner." This letter is your opening argument. Make it count. Now, let's talk about the evidence that backs up your opening argument. This is the documentation phase, and it's where most applications stall. The single biggest reason for denial of assistance is an incomplete application package. So let's build a checklist right now of what you will almost certainly need to gather. Get a folder, get a notepad, because this is the practical work that makes all the difference. We can break the documentation down into four main categories: proof of identity, proof of income, proof of hardship, and a complete financial picture. First, proof of identity. This is the easy part. You'll need a clear, legible copy of your government-issued photo ID, like a driver's license or passport. You'll also need your social security number. Simple enough. Second, and this is a big one, proof of income. The lender needs to understand every single dollar coming into your household. This isn't to judge you. It's to calculate what you can realistically afford to pay. If you're a W-2 employee, you'll need your most recent pay stubs, usually for the last 30 to 60 days. You'll also need your W-2 forms and federal tax returns for the last 2 years, including all schedules. If you are self-employed, this gets more complex. You'll need your last 2 years of tax returns, but you'll also need a year-to-date profit and loss statement, or P&L. This is a simple document you can create that shows your business revenue and your business expenses, resulting in your net income. What if your income isn't from a traditional job? You need to document that too. If you're receiving unemployment, you need the award letter and proof of recent benefits. If you're receiving Social Security, disability, or a pension, you need the award letters and statements showing the monthly amount. Alimony, child support. If it's income, you need the court order and proof of recent payments. Every single source must be documented. Third, proof of hardship. This is the evidence that supports your hardship letter. If your hardship was a job loss, include the termination letter from your employer. If it was a medical issue, include copies of the major medical bills. You don't need to send every single receipt, but the summary statements that show the large totals. If it's a divorce, you'll need a copy of the divorce decree or separation agreement. The goal here is to provide official documentation that corroborates the story you told in your letter. Fourth, a complete financial picture. The lender needs a full financial MRI. This means your last 2 months of bank statements for all of your accounts, checking, savings, everything. They will look at the deposits to verify your income, and they'll look at your spending habits. You'll also need to prepare a detailed list of your monthly household expenses. This is your budget: food, utilities, car payments, insurance, gas, phone bills, everything. Be honest and be thorough. Many lenders will provide you with a form for this, often called a Request for Mortgage Assistance, or RMA. This RMA form is essentially a standardized application that pulls all of this information together. It will ask for your personal information, details about your property, the nature of your hardship, your income, your assets, and your expenses. Fill this form out with extreme care. Do not estimate. Use the documents you've gathered to fill in the exact numbers. A small discrepancy between your pay stub and the income you list on the form can raise a red flag and delay your application. Honesty and accuracy are your best friends here. Now for a few pro tips, the things that can make or break your application. First, create a master file. Whether it's a physical folder or a dedicated folder on your computer, keep a copy of every single document you send to your lender. Every letter, every form, every pay stub. The number one frustration homeowners face is being asked for the same document over and over again. If you have your master file, you can simply say, "I sent that document on May 22nd via certified mail, and here is my copy." Second, keep a communication log. Every time you speak with someone from your mortgage company, write it down. Note the date, the time, the name of the person you spoke with, and a summary of the conversation. This log is invaluable if there are disputes or confusion later on. It demonstrates that you have been diligent and proactive. And third, never ever send your original documents. Only send copies. Keep your originals safe in your master file. This process of gathering documents can feel invasive and overwhelming. It can feel like you're being put under a microscope at the most vulnerable time in your life. But I want you to reframe that. This isn't an invasion. It's an inspection. You are presenting your case, providing the necessary data for a financial calculation to be made. By providing everything up front, completely and accurately, you are taking control. You are speeding up the process and dramatically increasing your odds of a positive outcome. You are moving beyond the panic of the problem and stepping firmly into the process of the solution. And now the most critical phase of that process begins: engagement. You've gathered your story, your documents, your proof. You are armed with the truth. It's time to communicate with your mortgage servicer, but not as a victim asking for a handout. You are engaging them as a partner in a difficult situation. A partner who has done their homework and is ready to find a workable path forward. When you call your servicer and ask for the loss mitigation department, you are entering a world with its own rules, its own language, and its own gatekeepers. Understand this. The first person you speak to is often just a call center employee with a script. Their job is to filter. Your job is to get past the filter to the person who can actually make a decision: a loss mitigation specialist, a case manager, an underwriter. Be polite, be firm, and be clear. I have completed my hardship application and have all my documentation ready. I need to speak with the specialist assigned to my case, or the person who can review my file for a decision. From this moment forward, you must become the most meticulous record keeper you have ever been in your life. Get a dedicated notebook. Every single time you have a conversation, you will write down the date, the time, the full name of the person you spoke to, and if possible, their employee ID number. You will summarize what you discussed, what they promised, and what the next steps are. This is not optional. This is your armor. In a he said, she said situation, the person with the detailed, contemporaneous notes always wins. Why? Because servicers are massive organizations. You will likely never speak to the same person twice. Your case file gets passed around, notes get lost, and promises are forgotten. Your logbook becomes the single source of truth. It allows you to say with unshakable confidence, "Actually, on Tuesday, May 14th at 2:15 p.m., I spoke with David, employee ID 7854, and he confirmed that you received my tax returns and that the next step was an underwriting review within 48 hours. Can you please confirm the status of that review?" That is a completely different conversation than, "I think I sent some stuff in last week maybe?" Even better than a phone call is an email or a message through their secure online portal. Written communication is your best friend. It creates an undeniable timestamp paper trail. After every phone call, send a follow-up email summarizing the conversation. Dear Sir or Madam, this email is to confirm my phone conversation today with David at 2:15 p.m., where we discussed X, Y, and Z. My understanding is that the next step is, whatever the next step is, please let me know if my understanding is incorrect. This simple act shifts the burden of proof. It forces them to either agree with your summary or correct it in writing. Now let's talk about the moment every homeowner dreads. The rejection. The denial letter. Feels like a punch to the gut. Feels final. All that work, all that vulnerability for a cold, formal no. Let me be crystal clear about this. A denial is not the end of the road. In many cases, it is simply the beginning of the real negotiation. Under federal law, if you submit a complete loss mitigation application more than 37 days before a foreclosure sale, the servicer must evaluate you for all available options and provide you with a written decision. If they deny you, they must tell you the specific reason why. They can't just say you don't qualify. They have to say, you were denied for a loan modification because your debt-to-income ratio was 58%, and the program guidelines require a maximum of 55%. Or, you were denied for a deferral because your hardship was not deemed temporary. This reason is not a judgment. It's a data point. It's a clue. And most importantly, that denial letter triggers one of your most powerful rights. The right to appeal. You typically have 14 days to file an appeal. This is your chance to challenge their reasoning. Maybe they calculated your income incorrectly. Maybe they didn't count your spouse's part-time job. Maybe the underwriter missed a key document you submitted. Your appeal isn't just an emotional plea. It's a structured argument. You go back to their specific reason for denial and you provide evidence to counter it. You stated my DTI was 58%. However, in your calculation, you included a car loan that was paid off on April 30th. I have attached the paid-in-full letter from the auto lender. With this corrected information, my DTI is actually 52%, which is within the program guidelines. I request that you reevaluate my application based on this corrected information. The appeal is reviewed by a different person or a separate team within the servicer. It's a mandatory second look. Many initial denials are overturned on appeal, simply because the homeowner was persistent and provided the right clarifying information. But what if the appeal is denied too? What if you feel like you're talking to a brick wall? This is when you stop just talking to the servicer, and you bring in the referees. This is when you escalate. Your first and best ally in an escalation is a HUD-approved housing counselor. We've talked about them before, but this is where they truly shine. They are a nonprofit, government-sponsored third party. They can review your entire case, your denial letters, and your documentation. They know the rules, they know the programs, and they often have direct contacts within the mortgage servicing companies that you don't have access to. They can make calls on your behalf and get your case in front of a supervisor who has the power to make an exception or overturn a bad decision. Their involvement signals to the servicer that this is no longer just a conversation between them and a stressed-out homeowner. It's now being monitored by a knowledgeable, professional advocate. If that still doesn't work, it's time to go to the top. It's time to file a formal complaint with the Consumer Financial Protection Bureau, the CFPB. The CFPB is the federal government's watchdog for financial products, including mortgages. Filing a complaint is free, and you can do it online. You lay out your entire story, upload your logbook, your denial letters, your appeal. And here is what happens next, and it is beautiful. The CFPB doesn't just forward your email. They log your complaint into a formal system, assign it a case number, and they officially serve it to a designated, high-level compliance department within your mortgage servicer. Your servicer is legally required to investigate your complaint and provide a formal, written response back to you and to the CFPB, typically within 15 days. Suddenly, your case is no longer in the hands of a random call center employee. It's on the desk of a senior manager in the executive office or the compliance department, whose job it is to resolve these formal complaints before they turn into a regulatory fine or a federal investigation. You would be absolutely astonished at how quickly problems get solved and final decisions get reversed when a servicer knows the federal government is watching. This entire process, the meticulous record-keeping, the written follow-ups, the formal appeals, the escalation to counselors and the CFPB, it's about changing the power dynamic. It's about refusing to be a passive participant in your own financial life. It's about understanding that the system has rules and checks and balances, and you have every right to use them. You are holding your servicer accountable to the law, and to their own stated policies. This isn't about being difficult, it's about being diligent. You are fighting for your home with the most powerful tools available: information, documentation, and persistence. You are proving that you are not just a loan number, but an advocate who will not be ignored. And by mastering this process, you're not just saving your home for today. You're building the skills and the resilience to secure your financial future for a lifetime. And this is the most critical mindset shift you can make. The process of saving your home isn't a one-time battle you fight and then forget. It's the training ground for a new way of life. Every document you organized, every call you made, every negotiation you entered, those weren't just hoops to jump through. Those were reps. You were building a muscle. The muscle of financial literacy, of self-advocacy, of unwavering persistence. This strength doesn't vanish once you get that approval letter for a loan modification. In fact, that's when it becomes more important than ever. Because securing a temporary solution is one thing. Building a permanent foundation of financial stability is another. This entire journey, this trial by fire, has given you an incredible gift, even though it felt like a curse. It has forced you to look at your finances with a level of clarity most people never achieve until it's far too late. You now know your numbers. You know your budget down to the dollar. You know exactly where the money goes. Do not let this clarity fade away. This is your new superpower. So what happens the day after? What happens when the immediate crisis is averted and you have a new manageable payment? The temptation is to breathe a sigh of relief and go back to the way things were. That is the single biggest mistake you can make. The way things were is what led to the crisis in the first place. The day after is day one of your new financial life. Your first mission is to transform your budget from a defensive tool, a way to simply survive, into an offensive weapon for building wealth and security. You've already done the hard part, tracking your spending. Now you optimize it. Look at every line item not as an expense but as a choice. Is this choice moving you closer to your goal of never facing this kind of stress again or further away? This isn't about depriving yourself of everything you enjoy. It's about intentionality. It's about deciding what you value most and funding that, while ruthlessly cutting what you don't. Maybe it's the daily $5 coffee, or the streaming services you barely use. That money isn't just saved. It's reallocated. It's redirected to its new critical mission, building your fortress. And the first wall of that fortress is your emergency fund, or as I prefer to call it, your freedom fund. Because that's what it is. It's the fund that gives you the freedom to say no to a bad situation, the freedom to handle a surprise car repair without a panic attack, the freedom to weather a job loss without immediately fearing for your home. Before this crisis, the idea of saving 3 to 6 months of living expenses might have seemed impossible. But now you've seen what the alternative looks like. You've lived the alternative. That memory is your fuel. Start small. Don't get discouraged by the big numbers. Your first goal is not 6 months of expenses. Your first goal is $1,000. That's it. Automate it. Set up a transfer of $20, $50, $100, whatever you can afford, from your checking to a separate high-yield savings account the day you get paid. Don't even let yourself see it. That $1,000 is your first buffer. It's the difference between a minor inconvenience and a full-blown catastrophe. Once you hit that, you celebrate the win and then you aim for 1 month's expenses. Then 3. You build the wall brick by brick. Simultaneously, you begin to address your credit. Your credit score may have taken a hit during this period of hardship. That's okay. It's not a permanent brand. It's a snapshot in time, and you have the power to change the next picture. The single most important factor in rebuilding your credit is simple: on-time payments. Every single one. Your new mortgage payment, your car loan, your credit card, your utility bills. Pay them all on time every time without exception. Set up automatic payments for at least the minimum amount due so you never miss one by accident. This consistent, positive payment history is the bedrock of a healthy credit score. Next, focus on your credit utilization, the amount of debt you're carrying compared to your credit limits. If your cards are maxed out, that's a major red flag to lenders. As you free up cash from your optimized budget, start paying down those balances. Don't try to tackle them all at once. Pick one, either the one with the highest interest rate or the smallest balance for a quick psychological win, and throw every extra dollar you have at it. Once it's paid off, you take the money you were paying on that card and roll it into the payment for the next one. This is the debt snowball or debt avalanche method, and it is incredibly powerful. Watching those balances shrink and disappear is one of the most empowering feelings in the world. But beyond the numbers, the budgets, and the credit scores, there's a deeper healing that needs to happen. Let's talk about the emotional toll. Financial hardship is incredibly isolating. It comes with a heavy dose of shame and a feeling of failure. You might have been hiding it from friends, from family, feeling like you were the only one. Let me be absolutely clear, you are not. Millions of Americans from every walk of life have stood exactly where you are standing. They are your neighbors, your colleagues, the people you see at the grocery store. Economic forces, medical emergencies, job losses. These are not personal failings. They are a part of life. The real failure would be to go through all of this and learn nothing. You have survived something that breaks many people. You stared into the abyss of losing your home and you fought back. You refused to be a victim. You became a student of the system, an advocate for your family, a warrior for your own future. That is not failure. That is the definition of resilience. You need to forgive yourself for any past mistakes and reframe this entire experience. This was not your downfall. This was your education, and you have paid the tuition. Now it's time to reap the rewards. And one of the greatest rewards is the ability to help others. The knowledge you've gained throughout this process is invaluable. You now understand the language of lenders, the intricacies of hardship programs, and the strategies for effective negotiation. Don't keep that knowledge to yourself. When you hear a friend or family member mention they're struggling, don't just offer sympathy. Offer guidance. Point them to the resources you used. Share the story of your own fight. You don't have to share all the personal details, but you can share the hope. You can be the person for them that you wish you had when you were at your lowest point. In doing so, you transform your personal struggle into a beacon for your community. We've covered a tremendous amount of ground in this series. We started in a place of fear and uncertainty, staring down a mountain of paperwork and confusing terminology. We broke it down piece by piece. We learned who to call, what to say, and how to say it. We uncovered the programs designed to help, and the strategies to ensure you qualify for them. We moved from a position of reaction to a position of power, armed with documentation, knowledge, and a plan. And now we stand here at the end of the series, but at the beginning of your next chapter. This is your story to write. The skills you've built are yours for life. The resilience you've forged is unbreakable. Your home is more than just walls and a roof. It's the backdrop for your life's most precious memories, and the foundation upon which you will build a secure and prosperous future. You have fought for it and you have earned it. So my final call to action is this. Don't just watch this and feel relieved. Take one thing you've learned from this entire series and put it into practice today. Make that call. Organize that folder. Set up that automatic transfer to your new Freedom Fund. In the comments below, I want you to make a public declaration. Tell us the one step you are taking starting now to own your financial future. By writing it down, you make it real. You make a promise to yourself. And if this series has provided you with value, with a roadmap, with even a sliver of hope in a dark time, then please share it with someone you know who needs to hear this message. Be the catalyst for their comeback story. Thank you for taking this journey. The path ahead won't always be easy, but you are no longer walking it alone or unprepared. You are now the architect of your own security. Go build it.